Ever imagine yourself like in one of those crazy trading rooms, screens everywhere, flashing all the market data, phones ringing off the hook?
Fortunes being made and lost in, what, seconds?
Yeah, exactly. You've got your own trading setup at home maybe, and you're ready to dive in, make some moves, but honestly, where do you even start?
Right. It could be so overwhelming.
Totally. Well, actually, you sent us this book, Dr. Alexander Elder's Study Guide for Entries and Exits, Looking for Answers.
Oh, that's a good one. Classic.
And well, that's what we're going to do today. We're going to pull out all those golden nuggets from Dr. Elder's visits to all those trading rooms, 16 of them, I think, and see what we can learn, to up our own trading game.
I love how Dr. Elder doesn't just focus on the technical stuff. He really digs into those habits and that mindset that separates the consistently profitable traders
from everyone else.
Yeah, from those who, just kind of spin their wheels.
Right. And he starts off with something that might surprise you. Organization.
Organization.
I know, right? Sounds kind of boring. But he compares a trader without a well-defined system to a fish without a bicycle.
Okay, I gotta admit, that's a pretty funny image.
Right. I mean, a fish with a bicycle. What's that about? But it makes you think.
It does. I mean, it's saying you need more than just gut feeling to succeed in trading, right?
So it's not just about knowing when to buy or sell.
No, it's about having a process, a system to guide you.
Through all the ups and downs.
Exactly. Through all the craziness it is the market.
So that includes how you set up your workspace.
Yeah, how you manage your time, how you think about money, your emotions, all of that.
Now, a lot of people assume that you need this massive multi-screen setup, like they show in the movies.
Wall Street, yeah.
To be a successful trader. But what did Dr. Elder actually find in those real-world trading rooms?
Well, a fast computer, reliable internet, those are givens. But he was actually surprised by how many of the pros prioritize simplicity over having a ton of screens and flashing lights. Well, yeah, the key is to have what you need to actually efficiently execute your strategy, not getting bogged down by a million things at once.
Okay, so it's about having a setup that works for you, not trying to copy what you see in the movies.
Exactly.
Now, a lot of people watching might be thinking, okay, organization, systems, got it. But I'm starting with a small account. Can I really compete with the big players?
Well, for sure. Dr. Elder actually found that traders with smaller accounts can sometimes be more disciplined.
Really?
Yeah. They're focused on building a solid track record, proving they can make good decisions, even with less capital.
So it's master the basics before you try to run a marathon.
That's a great analogy. It really is. And, paper trading is the perfect tool for this stage.
Paper trading? Isn't that just for, beginners?
No way. Even seasoned pros use it to test new ideas, refine their strategies.
So practice, basically, without actually risking real money.
Yeah, exactly. And once you have a strategy that you're confident in, Dr. Elder suggests a very specific way to allocate your trading capital. It's kind of
Okay, let's talk money. How do we divide up that trading capital?
Well, it's interesting. He compares it to how new traders often approach their education. They don't invest enough up front. And then, when they're struggling, they overspend trying to buy their way out of a mess.
So investing in knowledge and proven strategies from the start is key.
Yeah, learn from other people's mistakes, not your own, right?
Right. Now, Dr. Elder talks about the value of attending those trading conferences.
Oh, yeah, those can be great.
You learn from the pros, meet other traders, maybe even find a trading buddy, right?
Accountability. That's so important.
But, networking can also be risky, especially online.
For sure. There's a lot of noise out there.
Yeah. How do you separate the good stuff from all the hype?
Well, Dr. Elder noticed that while, connecting with other traders is great, you got to stay independent, thinking for yourself.
Because blindly following the crowd can lead to disaster, right?
Oh, yeah. Big time.
So develop your own style based on solid research and analysis.
Exactly. Not just on, what everyone else is doing.
Okay, so you've got your tech setup, your education, your paper trading. But how do you stay organized amidst all the, information overload?
Well, Dr. Elder suggests borrowing a technique from pilots.
Pilots?
Yeah, the pre-flight checklist.
Oh, interesting.
So just like pilots meticulously go through a checklist before takeoff, making sure everything's good to go.
Successful traders do the same thing before entering a trade.
Exactly.
What kind of things would be on, a trader's pre-flight checklist?
It could be anything, really.
Yeah.
Like, are the current market conditions actually good for my strategy? Have I double-checked my stop loss and profit target levels? Those kinds of things.
So it's about removing like the emotion from the equation, making sure you're trading with a clear head.
Exactly. And speaking of the mental game, Dr. Elder really emphasizes that trading is as much about psychology as it is about,
The technical stuff.
yeah, maybe even more so.
Okay, so let's dive into that. What did he observe about the mindset of successful traders? What makes them tick?
Well, one thing that really stood out to him was that they impose limits on themselves,
Yeah.
especially when it comes to managing risk.
So it's not about like being reckless and going for those big crazy wins.
No, no. It's about discipline and protecting what you've got.
And that's where the 2% rule comes in, right? Can you explain that again?
Sure. So the 2% rule is basically like a financial seatbelt. It limits your potential loss on any single trade to just 2% of your total account.
Okay, that makes sense. It prevents you from like blowing up your account on one bad trade. But what if you're on a roll, winning trade after winning trade? Doesn't that 2% rule hold you back from, making even more?
That's where the 6% rule kicks in.
Okay, the 6% rule. So it's like another layer of protection.
Exactly. It limits your total loss for the whole month.
Hmm.
Keeps you from getting carried away,
I see. So even when you're feeling invincible,
Which, let's be honest, we all do sometimes.
you've got that extra safeguard to keep you in check. Okay, so we've got risk management covered. But what about bouncing back from those inevitable losses? How do those pros handle those tough days?
Well, first of all, they acknowledge that losing is part of the game. Even the best traders have losing trades. It happens.
So accepting that it's just like part of the process, not some personal failure.
Right. And then they analyze those losses objectively.
Yeah.
What went wrong? Did they deviate from the plan? Was the market just not cooperating? That kind of thing.
So they turn those losses into like learning opportunities.
Exactly.
Now, I love how Dr. Elder warns against falling prey to what he calls the adult equivalent of waiting for Santa.
Oh, yeah.
What do you think he's talking about there?
Those black box systems.
Yeah.
The ones that promise easy money with no effort.
Ah, those get-rich-quick schemes.
Yep. And Dr. Elder compares relying on those to, well, a fish needing a bicycle. It just doesn't make sense.
So there's no magic formula?
Nope. Trading takes knowledge, experience.
Okay, so speaking of learning from the pros, what were some of those key takeaways that Dr. Elder got from those 16 trading rooms?
One of the things that surprised him was just how different all those traders' approaches were. There was no, single strategy that everyone swore by.
So it's really about finding what works best for you, right? Your personality, your goals.
Exactly. Some were focused on, technical analysis, charts and indicators.
Yeah.
Others were more into fundamentals. Some were in and out of trades, quickly scalping.
Yeah.
Others were holding positions for, months or years.
So experiment, see what clicks for you, and develop your own approach.
That's it. And you know what? Even in this age of algorithms and AI, a lot of those pros still relied on, manual charting.
Really? So those classic techniques are still relevant?
Oh, yeah, for sure. They felt like it gave them a deeper feel for the market,
So it's like reading a handwritten letter versus getting a generic email.
Exactly. That personal touch.
Now, I'm always curious how those pro traders manage their time. Are they glued to their screens all day?
It really varied. Some loved the constant action, being in the thick of it all day. Others were more relaxed, just checking in periodically, and only trading when they saw, a really good setup.
So find a rhythm that works for you.
Exactly. But one thing they all agreed on was the importance of having a clear separation between their trading life and their personal life.
No checking stock quotes at the dinner table.
Right. You need that balance so you can come back to the markets refreshed and ready to make smart decisions.
Now let's talk about slippage. It can be a real problem for traders, especially when you're trying to execute those carefully planned trades. Can you explain what slippage is?
Sure. Slippage is basically the difference between the price you expect to get and the price you actually get when you execute a trade.
So you might place an order to buy a stock at, say, $10, but because the market is moving fast, you actually end up getting filled at $10 or 5 cents.
Yeah, something like that. And those little differences can add up over time.
Especially if you're
Right.
trading frequently.
Right.
So how do you reduce slippage?
Well, one tip is to avoid trading during those really volatile periods.
Like around big news announcements.
Exactly. Be patient. Wait for things to settle down.
And Dr. Elder is also a big fan of using limit orders.
Oh yeah, limit orders are great.
Remind us why those are better than market orders.
Well, with a limit order, you're setting a specific price. So you're not at the mercy of the market, jumping around all over the place.
Okay, so if I place a limit order to buy a stock at $10 and the market jumps to $10.05, my order won't get filled unless it comes back down.
Exactly. You have more control.
Now, before we move on, I wanted to touch on that advice about allocating some of your capital to education. Why is that so important?
Well, Dr. Elder sees trading as a skill that you constantly need to be learning and improving.
So it's not just a one-time investment.
Nope, it's ongoing. Books, courses, mentors, even just observing the market and learning from your own experience.
Okay, so now let's get into the really interesting stuff, the psychology of trading. What did Dr. Elder discover about the mental game?
He found that successful traders are really good at managing their emotions.
Okay, that's easier said than done.
For sure. We've all felt that, adrenaline rush when a trade's going our way, or that pit in your stomach when it's not.
Yeah, so how do you manage those emotions?
Well, it starts with awareness. Recognizing those emotional triggers that lead to impulsive decisions.
Like the fear of missing out or FOMO.
Yeah, or the fear of loss. And then there's overconfidence. That can be a killer.
So you have to be aware of your own patterns, those internal signals that can lead you astray.
Exactly. And then you can start to develop strategies to manage them.
Like having a trading plan that you stick to no matter what.
Yes, a set of rules, a roadmap to help you navigate those emotional storms.
But what about being too rigid? The market is always changing, right?
That's a great point. And this is where experience and intuition come in. You need to be adaptable.
So it's about finding that balance between discipline and flexibility.
Exactly. That's one of the hallmarks of, those truly successful traders.
Now, Dr. Elder talks a lot about the trading diary. Remind us what that is.
It's basically a journal where you record your thoughts and feelings about each trade.
So not just the outcome, but like the why behind it.
Right. Why did you enter the trade? What was your analysis? How are you feeling? And then how did it actually turn out?
So it's like creating a feedback loop.
Exactly. You learn from your mistakes and you get better over time.
Now let's shift gears a bit and talk about the differences between, stocks, commodities, futures. What insights can we get from Dr. Elder about navigating those different markets?
One big mistake that traders make is assuming that stocks and commodities will always move together.
So they're not always correlated.
Not necessarily, no. Remember, stocks are ownership in companies and commodities are physical goods. And the things that drive their prices can be totally different.
So like a booming economy might be great for stocks, but not necessarily for, say, gold.
Exactly. Sometimes they move in opposite directions.
Interesting. Now, what about futures trading? I'll admit I'm a little intimidated by that.
Futures are definitely not for beginners. They require a lot of knowledge and a high tolerance for risk.
What are some key things to know about futures before jumping in?
Well, for one thing, those contracts have expiration dates. You can't just buy and hold them forever.
Ah, so you have to be aware of those dates.
Right. And futures are leveraged, which means you can control a lot of value with a small amount of capital.
Leverage. That sounds risky.
It can be. It's like driving a race car. It can be exhilarating, but you got to know what you're doing.
Okay, so let's talk about developing a trading system. What did Dr. Elder learn from those pros about creating a system that can, consistently make money?
One of the traders he interviewed, Fred Schutzman, had a 5-step process that I really like.
5 steps. Okay, I'm listening. What are they?
First, you identify a concept, some pattern or behavior in the market that you think you can profit from.
So, like, noticing that a certain stock tends to go up after good earnings?
Exactly. Or maybe you see a correlation between, say, gold prices and interest rates.
Okay, so then what?
Second, you visually check those signals on the charts. See if your concept actually plays out in the real world.
So backtesting your idea.
Yep. And if you get some visual confirmation, then you move to the third step, which is to formally test the system.
Using a computer.
Yeah, you can run simulations with historical data. Really put your system to the test.
And then?
Then you have to evaluate those results. Did your system actually make money? What were the drawdowns, those losing periods? And what was the risk-reward profile?
So make sure the system is actually robust.
Exactly. And finally, you turn that concept into a set of rules that you can follow consistently.
Ah, so it takes the emotion out of trading. You're not just guessing. You're following a plan.
Exactly. And that's the beauty of system trading.
Now, I've heard about the impulse system. Is that a good example of a trading system?
Oh, yeah. The impulse system is all about, censorship. It tells you when you can trade and, maybe more importantly, when you can't. Very selective.
So it helps you avoid, like, those choppy markets where it's hard to make money.
Exactly. And when it does give you a signal, it's very clear about, entries and exits
Yeah.
and risk control.
So those money management principles we talked about earlier are still crucial.
Absolutely. They're the foundation of any good system.
Okay, so we've covered the 2% and 6% rules for managing risk. What about tracking your trades and, like, analyzing your performance? What should we be recording?
Everything. The date, price, size, commissions, slippage. It might seem like a lot, but it's super valuable to understand what's working and what's not.
So not just celebrating the wins and being bummed about the losses, but really digging into the details.
Exactly. And this is where that trading diary comes in handy.
Okay, you've piqued my curiosity about this trading diary. Tell me more.
Think of it like a conversation with yourself.
With myself.
Yeah, like you're documenting your thought process, your emotions, even your observations about the market. It's like, why did you enter this trade? What were you thinking? How did it turn out?
So you can learn from your mistakes.
Exactly.
Okay, now we're getting into the really good stuff. The moment of truth. Placing the trade. We've got our plan, we're managing risk, but what about actually entering and exiting?
This might surprise you, but Dr. Elder actually recommends avoiding market orders whenever possible.
Market orders.
Yeah, those are just like saying buy or sell whatever the current price is. It's the fastest way to get in or out. It can also be costly.
Costly. How so?
Well, if the market's moving fast, you could end up getting a much worse price than you expected.
So use limit orders instead.
Exactly. With a limit order, you set a specific price. You're in control.
Okay, so you've identified your trade, you're using a limit order. But how do you handle those emotions when the market starts moving, especially if it's moving against you?
That's where having a plan is key.
So not making decisions based on fear or, getting greedy.
Right. You're sticking to your rules.
And that plan includes your profit target and your stop loss, right?
Absolutely. You're setting boundaries for yourself.
Upside and downside.
Exactly. Dr. Elder also talks about OCO orders, which can be helpful.
OCO orders?
Yeah, it stands for one cancels the other.
What does that mean?
So you can place a stop loss order and a profit target order at the same time. And if one of them gets executed, the other one automatically cancels.
Oh, that's clever. So you're always protected.
Exactly. Now, Dr. Elder uses a lot of real-world examples in his book using charts and stuff. We obviously can't see those here, but we can still get some good insights from his analysis.
Totally. And one of the key things he highlights is the importance of, listening to the market.
Reading its messages.
Yeah. So it's like the market is trying to tell us something.
Exactly. And those who can understand those messages, those subtle signals, they often have a big advantage.
So learning the language of the market.
Exactly. And one of the most important messages the market can send is a trend reversal.
Trend reversals. This can be tricky to spot. How do you know when a trend is really reversing and not just taking a break?
Well, that's where those charting techniques come in handy. Look for breaks of support and resistance, changes in momentum, and confirmation from your indicators.
So it's not just one candlestick going in the opposite direction, but a bunch of signals all lining up.
Right. Dr. Elder shows that there are often early warning signs.
What kinds of warning signs?
Well, one common one is a divergence between the price action and the momentum. For example, the price might be making higher highs, but the momentum indicator, like the MZD, is making lower highs.
So it's like the price is moving up, but the strength of the trend is weakening.
Exactly.
And he also talks about the force index.
Right. If the price is going up, but the force index is falling, it's a sign that the rally is running out of steam.
So you're looking for those subtle cracks in the foundation.
Exactly. Those can help you anticipate those turning points.
Now let's talk about overbought and oversold conditions.
Okay, so imagine stretching a rubber band. You stretch it too far, it's going to snap back.
Ouch. Okay, I get it.
Right. Overbought and oversold conditions are kind of like that. It's when the price has moved too far too fast and is likely to, revert back.
So overbought means it's gone up too much and is due for a pullback.
Right.
And oversold means it's gone down too much and is due for a bounce.
Exactly. And there are indicators that can help you spot these conditions.
Like the RSI.
Yep, the RSI, the stochastic oscillator, Bollinger Bands.
Can you give a quick overview of those?
Sure. So the RSI measures the strength of recent price changes. Above 70 is overbought, below 30 is oversold.
Okay. And the stochastic oscillator?
It compares the closing price to the price range. Above 80 is overbought, below 20 is oversold.
And Bollinger Bands?
Those show the standard deviation of price. If the price moves outside of those bands, it can be a sign of an overbought or oversold condition.
Okay, so they help visualize those extreme moves.
Exactly.
Now, Dr. Elder talks about a candlestick pattern called the kangaroo tail. What's that all about?
It's a candlestick with a tiny body and a really long tail.
I can picture that.
Right. So it shows that the price moved a lot in one direction, but then quickly reversed.
So, like, the market was testing a level, but then got rejected.
Exactly.
Now, what about false breakouts? Those can be so frustrating.
Oh, yeah. Classic market trap.
How do you avoid those?
We'll wait for confirmation before jumping in.
So don't just buy as soon as the price breaks above a resistance level.
Right. Wait for the volume to confirm, look for follow-through, check your indicators.
Be patient.
Exactly.
Now, Dr. Elder asks a really interesting question. Is a trader with a scientific background more or less likely to succeed? What are your thoughts?
That's a tough one. A scientific mind can be helpful, for thinking systematically, analyzing data, building systems.
So those skills of observation, analysis, all that.
Yeah, all those things. But it can also be a problem if it leads to, rigidity.
Like thinking there's a perfect system that can predict everything.
Exactly. Trading is more than just numbers.
You need that intuition, that flexibility.
Right. You need to be comfortable with, a little bit of uncertainty.
Now, let's go back to that analogy about the fish and the bicycle. Why do you think that resonates so much with traders?
I think it really captures the essence of what it takes to succeed in the markets. You need a system, a set of rules to guide you.
So you don't get lost in the chaos?
Exactly. You need that structure, that anchor.
To keep you grounded.
Exactly.
And that system isn't just your trading strategy, it's also your money management, your record keeping, even your psychology.
It's all connected.
Dr. Elder's book really gives us a lot to think about, a lot of tools to build that foundation and navigate the markets.
And don't forget about the psychological aspects. Those are so crucial.
Right. Understanding those traps like FOMO and chasing losses, that's so important.
And the trading diary is such a simple but powerful tool for managing all that.
Okay, before we wrap up, any tips for finding a trading style that really suits you?
It's all about exploration. Try different things. See what feels right. Do you like charts and indicators? Or are you more into company financials? Do you like fast-paced trading, or are you more of a long-term investor?
So experiment.
Exactly. And as you get more experience, you'll start to develop your own style.
That's when it gets really fun.
Totally.
Right.
When you're not just following someone else's rules, but you're expressing your own understanding of the markets.
Well, that's a great place to leave it for now. Thanks for diving into Dr. Elder's book with me.
My pleasure.
And to everyone listening, remember, trading is a journey.
It's a marathon, not a sprint.
Stay disciplined, keep learning, and enjoy the ride.
See you next time. You need a blend of analytical skills and intuition. You got to be willing to adapt, as the market changes. And you got to be humble enough to know you won't have all the answers.
So it's not just about being a scientist, but maybe an artist too, a psychologist, even a poker player, maybe, reading those market tells.
Yeah, I love that. Trading really is multifaceted. It's not just numbers. You got to understand human behavior, control those emotions, be okay with a little uncertainty.
Speaking of uncertainty, let's go back to that analogy. The trader without a system is like a fish without a bicycle. Why does that hit home for so many traders, do you think?
Well, it really gets to the core of what separates those who consistently make it in the markets,
Like winners from the...
The winners from, everyone else. Fish doesn't need a bicycle, right?
Right.
It's got everything it needs to swim to survive.
Fins, gills, instincts.
Exactly. But a trader out there in the wild world of the markets, you need something more. You need a system. Rules, principles to guide you.
So like a framework to navigate those choppy waters.
Yes.
Yeah.
That's a great way to put it. You need something to keep you from getting swept away by, all the fear and greed.
So a well-defined trading system, it gives you that structure.
That anchor.
To keep you grounded.
Exactly.
And as we've been talking about, that system's not just your entry and exit signals.
Yep.
It's your money management, keeping good records, even how you think about the market psychologically.
A whole package deal.
I think that's what's so great about Dr. Elder's book. He really gives us a blueprint for building that foundation.
And I love how much he emphasizes the psychological side of trading.
Right. That's so often overlooked.
But it's crucial. You got to understand those traps.
The FOMO, the get-rich-quick schemes.
Chasing losses, yeah. All those things that can really mess you up.
And that trading diary is like such a simple but effective way to keep those emotions in check.
It really is.
Okay, before we move on, any last tips for finding a trading style that really fits, your personality.
Hmm. I think it really is a process of self-discovery. There's no right answer. But start by just, exploring the different styles out there. Do you like charts and indicators? Do you prefer analyzing company financials? Do you like quick trades or long-term investments?
So just try different things.
Yeah. And as you get more experience, you'll start to see what works best for you.
That's when it gets really exciting.
Right, sure.
Yeah.
When you're not just following someone else's rules, but you're expressing your own understanding of the market.
All right. Well, I think that's a great place to wrap up our deep dive into Dr. Elder's book.
It's been a pleasure.
And to everyone listening, remember, trading is a journey. It's a marathon, not a sprint. So stay disciplined, keep learning, and enjoy the ride. We'll be back next time with more insights and tips to help you navigate the markets.
It's about finding that sweet spot, blending those analytical skills with your intuition, being ready to adapt when the market throws you a curveball, and honestly accepting that you'll never have all the answers.
So you're not just a scientist. You're an artist, a psychologist.
Maybe a little bit of a poker player, too.
Reading the markets tells, adjusting your strategy. I like that.
It's true, though. Trading has so many different facets. It's not just numbers and charts. It's about understanding how people behave, keeping your own emotions in check, being comfortable with...
Not knowing everything.
Yeah, exactly. Embracing that uncertainty.
Okay, I want to circle back to that analogy about the fish and the bicycle one more time. Why do you think that resonates so strongly with, with traders?
It really gets to the core of, what separates those consistently profitable traders from everyone else. You know what I mean?
Yeah, yeah.
A fish doesn't need a bicycle because it's built for its environment, right? That fins, gills, instinct.
It's got everything it needs.
Exactly.
Yeah.
But a trader operating in this, this crazy world of financial markets, you need something more, a system, something to guide your decisions.
So a set of rules and principles to keep you afloat in those sometimes treacherous waters.
That's a great way to put it. You need something to keep you from getting swept away by those currents of,
Fever and greed.
Exactly. A solid trading system, it gives you that structure, that anchor that keeps you steady when the storms hit.
And like we've been saying all along, that system, it's more than just entries and exits.
Oh, way more.
It's your money management, your record keeping, your whole mental game.
It's about understanding that all those pieces, they fit together.
Yeah, and Dr. Elder, he really gives us a roadmap for how to put it all together. I especially appreciate his emphasis on the psychology of trading.
Me too. It's so important.
Understanding those traps like FOMO, the allure of those black box systems,
Chasing losses, all that stuff.
Recognizing those patterns, those tendencies that can really sabotage your results.
It can make all the difference.
And using tools like that trading diary to keep those emotions in check.
Simple but powerful.
Okay, before we go, any parting words of wisdom for, our listeners who are trying to find that trading style that really clicks for them?
It's a journey.
Yeah.
You got to explore, you got to experiment, you got to try different things and see what feels right.
What resonates.
Exactly. Do you like technical analysis, or are you more into fundamentals? Are you a fast-paced trader, or do you prefer to hold positions for a long time? There's no one right way to do it.
It's about finding what works for you.
Yeah, and as you get more experience, you'll start to develop your own unique approach.
That's when it gets really fun, right?
Oh, absolutely. When you're not just following someone else's rules, but you're expressing your own understanding of the markets, it's a whole different level.
All right. Well, I think that's a perfect note to end on. Thanks for joining me for this deep dive into Dr. Elder's work.
It's been my pleasure.
And to everyone listening, remember, trading is a journey, a marathon, not a sprint. So pace yourself, stay disciplined, never stop learning, and, enjoy the ride. We'll see you next time. All right, get ready, because today we are going to take a deep dive into high-frequency trading.
Oh, yeah.
We've got some really interesting excerpts here from Irene Aldridge's book, High Frequency Trading, a practical guide to algorithmic strategies and trading systems.
Sounds dense.
It is a fascinating book, and today we're going to try to unpack it, figure out just what HFT is,
right,
how it came to be, what makes it unique, and what are some of the things people should think about if they want to learn more about it.
Yeah, it's definitely a hot topic, and people throw the term around a lot.
Yeah, so this book dives right into the four main HFT strategies:
Okay.
automated liquidity provision, market microstructure trading,
Mm-hmm.
event trading, and deviations arbitrage.
Yeah.
And the thing that really struck me is that all of these operate at like blazing fast speeds.
Oh, yeah.
We're talking milliseconds here.
That's the thing, right? That's what makes it high frequency.
Exactly. That speed. Do you think that's what sort of mystifies people about it? Like it's almost too fast to even comprehend.
Yeah. It definitely contributes to that sort of mystique.
Yeah.
And the fact that it needs to be, it necessitates algorithms to handle all that.
Right.
Because humans just can't keep up.
Yeah. It makes you wonder, is there even room for human intuition in trading anymore?
Right.
Or if it's all becoming a game of who's got the fastest computers and the slickest algorithms.
Yeah. Well, that's a great question, and something I think we'll keep coming back to as we dig deeper into this.
Okay.
But to understand where we are now, we need to rewind a bit and see how we even got here.
Right.
And Aldridge points to the early 1990s as this kind of turning point.
Okay.
This is where we see the rise of electronic platforms like CME's Globex, which really changed the game.
Absolutely. And it wasn't just the technology itself.
Yeah.
The whole structure of financial services was shifting.
Yeah.
We're going from these like hierarchical models to these decentralized networks.
Mm-hmm.
It's almost like the internet itself is reshaping how the markets function.
Yeah.
Exactly. It's like this parallel evolution. And the book actually brings this to life with some pretty mind-blowing stats.
Okay.
Think about this. Back in 1923, the NYSE saw about 1 million shares traded daily.
Wow.
Fast forward to 2003, and that number explodes to over 1 billion.
That's crazy.
Yeah, that's the kind of volume that demands a whole new approach to trading.
All of a sudden, those classic methods like technical analysis, where you're looking for patterns and price charts, it's kind of like using a horse and buggy on the Autobahn.
Yeah, you're going to get run over pretty quickly, and that's exactly what started happening.
Yeah.
Technical analysis started to lose its edge, especially at those lower frequencies, once these big institutional investors started using computers to spot those patterns before they were even visible to the human eye.
So it was almost like the machines were like front-running human intuition.
In a sense, yeah, they're able to process information and react.
Yeah. Much faster. But it's interesting, though, because while it declined at those lower frequencies, technical analysis actually remained very relevant at the higher frequencies where HFT operates.
Interesting. So it's like this, almost like an arms race.
Exactly.
Between trying to exploit patterns and then predict how those patterns will be exploited by others.
Exactly. Yeah, it's this constant back and forth.
Wow. So even as things were changing, some of the core principles still held their ground, just in this new, much faster form.
Yeah, and that's true for fundamental analysis as well.
Right.
It's not like it disappeared, but it evolved. Right. You know, it went beyond just crunching those cash flows. We started factoring in expected economic variables, really sophisticated econometric models to get ahead of the curve.
So the game's gotten more complex, but the goal's still the same.
Right.
Find an edge and make those profitable trades.
Exactly. It's still about finding those inefficiencies.
Which brings us to the business side of HFT. Because even if you've got the slickest algorithms, you need an operation that can actually turn a profit.
Of course. Got to pay the bills.
Right. So what kind of returns are we talking about here?
Yeah.
For an HFT operation to even break even?
Well, Aldridge lays out this hypothetical 5-person operation.
Okay.
Just to kind of illustrate the point. And even with minimal salaries, overhead, all that, they need to generate at least a 12% return per year just to stay afloat.
That's a steep climb.
Yeah.
You know, it really makes you realize this isn't some get-rich-quick scheme.
Yeah.
Like, there's real financial pressure involved.
Absolutely. And this is where things get even more interesting.
Oh.
Leverage.
Leverage.
The double-edged sword.
Right. So by borrowing money,
exactly,
you can really boost their trading capital.
Yep.
But it also magnifies the risk, right?
It does. Absolutely. You're basically putting your foot on the gas pedal.
Yeah.
Knowing that you could win the race or, well,
crash and burn.
Crash and burn spectacularly.
All right. So high risk, high reward.
Yeah.
But Aldridge makes this really crucial point.
Okay.
A high Sharpe ratio can actually help mitigate that risk.
Right. So it's not just about taking on as much risk as possible.
Right.
It's about doing it strategically.
Okay. So for those of us who aren't fluent in Wall Street jargon, break down the Sharpe ratio.
Sure.
What is that, and why is it such a big deal in the HFT world?
So the Sharpe ratio, you can think of it as like a yardstick.
Right.
For risk-adjusted returns. It tells us how much return we're getting for every unit of risk we take on.
Okay.
So a higher Sharpe ratio
Yeah.
means we're squeezing more juice out of that risk.
Gotcha. So it's not just about making money, it's about making it smart.
Exactly.
Yeah, like threading the needle between profit and that potential for a total wipeout.
Exactly. You got it. And in HFT, where things move so fast and volatility is just part of the game, a high Sharpe ratio
Yeah.
is basically your survival kit.
All right, so before we get too lost in the algorithms, let's step back and look at the big picture for a second.
Sure.
Which markets are even suited for HFT in the first place?
Ah, good question.
Like, what are the make or break criteria?
Well, Aldrich highlights two main factors: liquidity
Okay.
and electronic trading.
Makes sense.
So the market needs to have plenty of buyers and sellers.
Right, because otherwise your algorithms are just sitting there twiddling their thumbs.
Exactly. There's no one to trade with.
And without electronic trading, even the fastest algorithm is still going to be waiting for, like, a human to push a button.
Right? It's a bottleneck.
Yeah.
So both of those have to be in place.
And the book actually gives some really interesting insights
Yeah.
into average daily volume and execution methods in different markets.
It does. It breaks it down pretty nicely.
Like, I was blown away by the sheer scale of the Forex market.
It's massive.
It's like dwarfs everything else.
Absolutely. It's the Wild West of finance, constantly in motion.
Yeah. Tons of opportunity, but also a lot of potential for things to go haywire. And because it's so heavily electronic,
Right.
it's just a breeding ground for HFT.
Exactly. Ripe with opportunity.
Now, contrast that with something like fixed income markets.
Like bonds.
Yeah, bonds, they tend to be, less liquid, more reliant on those old school over-the-counter trades.
Right, which makes them less appealing for HFT.
So even within the financial world, there are, like, clear winners and losers when it comes to suitability for HFT.
Absolutely. Yeah, some markets just lend themselves to it better than others.
So it's not a one-size-fits-all kind of thing.
Nope, not at all.
Now, let's dig into those specific quirks of each asset class, because it's not just about the overall market, right? You have to zoom in.
You got to look at the individual instruments.
Yeah.
So, for example, fixed income.
Yeah.
A lot of investors there, they're focused on those payouts.
Right, not those short-term price swings.
Exactly, which HFT thrives on.
Yeah, it's like trying to play, like, a speed chess game against someone who's playing, like, a slow strategic game of Go.
Right, completely different mindsets.
Yeah, different rules, different pace.
Yep.
Okay, so let's dissect some of those markets.
Right.
Starting with interest rate markets.
Okay, so in interest rate markets, we've got spot interest rates.
Okay.
These are the rates that banks charge each other
Okay.
for those short-term loans. So think of it as like the cash rate for interbank lending.
So it's like the heartbeat of the banking system.
Exactly, yeah. It's what keeps everything flowing.
And how do these spot rates relate to interest rate futures contracts?
So those futures contracts are basically bets on where those underlying spot rates will be at a future date.
Okay.
And they're typically more liquid than the spot market itself.
Okay.
So potentially more interesting for HFT.
But still not as wild as Forex.
Not quite, no.
So it's like buying a ticket to a concert based on how much you think the tickets will be worth on the day of the show.
I like that analogy.
Yeah.
You're speculating, but there's still some grounding
Right.
in the underlying value.
Okay, now what about bond futures?
So bond futures, these are contracts based on those longer-term government bonds
Okay.
maturing over several years.
Mm-hmm.
So they're a different beast from those interest rate futures
Right.
because they're not as influenced by central bank actions.
Okay, so bond futures are more about playing the long game,
Exactly.
riding those, like, bigger economic waves,
Right.
while interest rate futures are more about those quick, choppy price movements.
Exactly, which is what HFT loves.
Right. Okay, so we've talked about Forex.
Yeah.
We know it's massive. We know it's electronic.
Yeah.
What was that catalyst?
The catalyst was the collapse of the gold standard in 1971.
Ah, okay.
So before that, exchange rates were pretty much locked in place.
Right.
But once that anchor was gone, currency markets just went wild.
Yeah, like someone pulled the rug out from under the global financial system.
Jack, yeah.
And all of a sudden, these currencies are just floating around, bouncing off each other like bumper cars.
A perfect image.
And over time, those markets embraced electronic trading.
They did.
And that created basically the perfect storm for HFT.
You did. It was the perfect breeding ground.
So the rise of HFT wasn't just some, like, random tech innovation.
Oh,
It was a direct consequence of these like huge shifts in global finance.
exactly.
Well, like evolution in action, the market adapting to survive
It had to have that.
in this new environment.
Yeah.
And to wrap up our market tour, let's touch on equity markets.
Okay.
Specifically, those equity futures contracts.
All right. So these are based on the value of stock market indices.
Right. And from what we saw earlier, they're also like buzzing with activity.
Oh, yeah. Lots of liquidity.
Yeah, plenty to fuel those algorithms.
Yeah.
And they're electronically traded.
Yes.
So that makes them a natural fit for HFT.
They are, absolutely.
Okay, so we've got a good sense of which markets are HFT friendly,
Mm-hmm.
but let's circle back to risk.
All right. Always important.
How do you even measure risk
Yeah.
in this context?
That is the question, isn't it?
Where things are moving so fast.
Yeah, because you can't just rely on those traditional metrics.
Like standard deviation.
Well, standard deviation is a good starting point,
Okay.
but it only tells us the average deviation from the mean, right?
Okay.
So it doesn't capture those rare but potentially catastrophic
Oh, right.
events that are lurking out there in the tails.
We're talking about tail risk.
Exactly. Tail risk.
So it's like knowing the average temperature in a rainforest doesn't tell you about the possibility of a flash flood. You need a different way to think about risk.
Exactly. You need something more.
Okay, so what else do we have?
Well, one approach is maximum drawdown.
Okay, maximum drawdown. Break that down for me.
So maximum drawdown tracks the biggest peak to trough decline
Okay.
in our portfolio's value. So it basically tells us the worst possible loss we've experienced over a given period.
So it's like looking back at a mountain range and saying, okay, that was the deepest canyon we had to climb out of.
I like that.
Gives you a sense of like the worst case scenario.
Exactly. Yeah, it gives you a sense of the magnitude
Right.
of that potential downside.
So we've got standard deviation for the average volatility
Yep.
and maximum drawdown for those extreme events.
Right.
But how do we actually compare different HFT strategies?
Yeah, that's a good question.
Because just looking at the average return
Mm-hmm.
and these risk measures, that doesn't tell the whole story.
No, it's like trying to compare apples and oranges.
Right, you need a common denominator.
Exactly. And luckily, we have a whole arsenal of comparative metrics at our disposal.
Like the Sharpe ratio,
Sharpe error ratios back.
Jensen's alpha, Traynor ratio.
There's a lot to choose from.
Yeah, it's a lot to juggle.
But remember, Sharpe ratio is always a good starting point
Okay,
because it factors in both the return and the risk.
right.
So it gives us that single number.
So it really seems to be the MVP in the HFT world.
It plays a key role, but like any metric, it's not perfect.
Okay.
Some critics point out that it doesn't fully capture tail risk.
Right, because it's lumping those positive returns into the volatility calculation.
Exactly. So you could have a strategy with a seemingly great Sharpe ratio,
Right.
but still be vulnerable to those nasty surprises.
Hiding in the tail.
Exactly. Lurking in the shadows.
So you got to watch out.
You do. And that's why Aldrich introduces
Yeah.
this whole family of Greek ratios that address this issue
Okay.
by focusing specifically on that downside risk.
So it's like a whole like toolkit for measuring and managing risk.
It is. You got to use the right tool for the job.
Right.
And another popular way to summarize that tail risk
Yeah.
is value at risk, or VAR.
Okay, yeah, I've heard that term thrown around.
It's a popular one.
But remind me, how does VAR actually work?
So VAR tells us the maximum potential loss
Okay.
we could expect within a given time frame and confidence level.
Okay.
So for example, if we have a 95% VAR of 2% over a one-day period, that means there's only a 5% chance of losing more than 2% of our portfolio value in a single day.
So it's like a statistical safety net.
Yeah, it's kind of like setting a limit
Okay.
on how much you're willing to lose.
Gotcha.
Now, there's also a related measure called conditional VAR, or CVR.
Okay, and what's the difference?
So while VAR tells us that maximum loss threshold,
Okay.
CVR tells us the average loss
Okay.
we can expect within that tail. So it's like, given that we've already tripped over that VAR threshold,
Yeah.
here's the average damage we're looking at.
So CVR is like planning for damage control.
Exactly. It's like having insurance.
Okay, so we've talked about what HFT is.
Mm-hmm.
We've talked about how it came to be
Yep.
and how we measure the risk involved.
Right.
But what are those HFT strategies actually exploiting?
The $1,000,000 question.
Like, what makes them tick?
Well, at its core, HFT is all about exploiting inefficiencies in the market.
Okay.
If markets were perfectly efficient,
Right.
meaning all information was instantly reflected in prices,
Mm-hmm.
there would be no opportunities for HFT.
So they're kind of like those sharks that can detect tiny electrical impulses in the water, right?
Yeah. That's a good analogy.
They're sensing those inefficiencies that most traders would completely miss.
They're looking for those tiny discrepancies.
And those inefficiencies can come from a variety of sources.
They can?
One that Aldridge mentions is market microstructure.
Right, so that's the nitty-gritty of how markets actually function.
Yeah, the order book,
The bid-ask spread,
the different types of orders.
all of that.
And how does that create opportunities?
Well, think about it. Every time someone places an order,
Yeah.
it reveals a little bit of information, right? About their intentions, what they think the asset is worth.
Right.
So HFT algorithms are designed to sniff out those signals and exploit those fleeting price discrepancies.
So it's like reading the market's body language.
It is. It's like picking up on those subtle cues that most traders wouldn't even notice.
Okay, and one of those cues is the difference between statistical and economic arbitrage.
Ah, yes. Good point.
So what's the distinction there?
So statistical arbitrage focuses purely on those statistical relationships between securities.
Okay.
Without necessarily needing to know the underlying economic reasons.
So it's more data-driven.
Yeah, exactly. Let the numbers tell the story,
Okay.
even if we don't fully understand the narrative.
Gotcha.
Economic arbitrage, on the other hand, is about exploiting deviations from those fundamental economic principles.
Okay.
So, for instance, if two assets should theoretically be priced similarly,
Right.
but they're not,
Yeah.
that's where an economic arbitrager would step in.
Okay, so statistical arbitrage is about finding those quirks in the data.
Yeah.
And economic arbitrage is about spotting those mispricings based on those deeper economic relationships.
Precisely. Two different approaches.
Okay, so we've got the strategies. Now let's talk about the data itself.
All right, the fuel that powers the engine.
Because HFT obviously requires a ton of data.
It does. It's data hungry.
But as Aldridge points out, it's not just about quantity. It's about quality.
Absolutely. You need the right kind of data.
So we're talking about tick data?
Tick data.
Capturing every price change, every transaction.
Down to the millisecond.
Sometimes even down to the millisecond.
It's a lot of data.
It's a fire hose of data.
It is, and it comes with its own set of challenges.
Yeah, like how do you even handle that?
Well, one of the challenges is that it arrives irregularly.
Right.
Unlike traditional price data,
Yeah.
that comes in nice, neat intervals.
Yay.
Tick data comes in bursts,
Okay.
depending on how active the market is.
So it's not something you can just like plug into a spreadsheet
No,
and analyze with like those standard tools.
you need specialized techniques.
Okay, and what are some of those techniques?
Well, one approach is to use duration models,
Duration models.
which are specifically designed to analyze events that occur at irregular intervals.
So it's not just what happened, but when it happened.
Exactly. The timing is crucial in HFT.
Okay.
And another challenge with tick data is dealing with that bid-ask spread.
Right. The difference between the highest price a buyer is willing to pay
Yeah.
and the lowest a seller is willing to accept.
That's it.
And Aldridge pointed out that those tiny price changes in tick data can sometimes be even smaller
They can be.
than the bid-ask spread itself.
It's like trying to thread a needle in a hurricane.
It's incredible.
It's a very tight space to operate in.
So your algorithms need to be like incredibly precise.
They do. They need to be very sensitive to those price movements
Yeah.
and understand those spread dynamics.
Right. Otherwise, you're just going to get eaten alive by those costs.
Exactly. The costs will wipe out any potential profit.
It's like they need to have like microscopic vision and like lightning fast reflexes
You got to be quick on the draw in this game.
to capture those fleeting profit opportunities.
Exactly. It's a very fast-paced environment.
All right, so let's dive deeper into how those HFT algorithms
Okay.
actually exploit that market microstructure.
All right, let's get into the nitty-gritty.
One concept that Aldridge discusses is order aggressiveness.
Right, so that's how quickly a trader wants their order filled.
Right, so we've got those market orders being the most aggressive,
The go-getters.
and then the limit orders being a little more patient.
Right, they're willing to wait for the right price.
So it's like sprinting versus pacing yourself for a marathon.
Exactly. Different strategies for different goals.
And Aldridge explains how this aggressiveness can actually be a signal for those HFT strategies.
You can. It can tell us a lot about the intentions of the trader.
Because those informed traders, the ones who really have a good understanding of an asset's value,
Blows with an edge.
they tend to use those more aggressive orders.
They do. They're not afraid to pay a premium for speed.
Yeah, because they're confident they're getting a good deal.
Exactly.
And they want to lock it in before anyone else catches on.
They don't want to miss out.
So the HFT algorithms can pick up on these signals and use them to kind of predict
Right, they can
where
anticipate.
the price is headed.
Exactly. It's like watching a poker game and noticing how the players bet.
Yeah, you can tell who's bluffing and who's got the strong hand.
Exactly. You can read their tells.
So these algorithms are like poker pros, reading the subtle cues in the market's behavior to gain an advantage.
Exactly. They're always looking for an edge.
It's incredible to think these algorithms are playing this like high-stakes game of chess against the entire market,
That's a good way to put it.
using every bit of information to outmaneuver their opponents.
It's a constant battle for supremacy.
And one area where this kind of analysis is particularly important is in event arbitrage,
Ah, yes, event arbitrage.
where you're trying to capitalize on those market swings around those big events.
Right, like news announcements, earnings releases, that sort of thing.
Speed and precision are everything in that game.
Absolutely. You got to be quick on the trigger.
And Aldridge gives us a fascinating example
Oh,
of this in action,
okay.
trading the USD-CAD currency pair
Okay.
based on U.S. inflation announcements. And the analysis revealed something quite surprising.
Okay, I'm intrigued. What did they find?
Well, it turns out that the market actually reacts more consistently to decreases
Interesting.
in the U.S. inflation rate
Okay.
than to increases.
That is surprising. You'd think any big news, good or bad,
Yeah.
would create volatility
Right.
that those algorithms could exploit.
Exactly.
But this just goes to show why that rigorous statistical analysis
Yeah.
and backtesting is so crucial in HFT.
Yeah. You can't just rely on intuition
No,
or conventional wisdom.
you got to let the data be your guide.
Right. Sometimes those hidden patterns in the data reveal opportunities that would never occur to us
Yeah.
just by, like, observing the market.
It's all about uncovering those hidden gems.
Now, let's bring back statistical arbitrage.
Right.
Remember, it's about exploiting those statistical relationships between securities.
Even if there's no clear economic explanation for why they exist.
Right, but we also talked about the danger of those spurious relationships.
Oh, yeah, those correlations that seem statistically significant,
Right.
but are actually meaningless.
It's like ice cream sales and shark attacks.
Exactly. Classic example.
That's a trap that even seasoned HFT practitioners can fall into.
Absolutely. It's easy to get fooled by randomness.
And Aldridge gives a great example
Okay.
of a spurious relationship between time
Time.
and the return of a particular stock.
Interesting.
You know, just because a company is expected to grow over time
Right.
doesn't mean that time itself
Yeah.
is a reliable predictor of its stock price.
It's a classic case of correlation not equaling causation.
Exactly. So just because two things happen to move together
Right.
doesn't mean there's a genuine opportunity to profit from that relationship.
You got to dig deeper.
And that's why incorporating those economic fundamentals
Yes.
is so crucial.
Absolutely.
You need to understand not just what's happening,
Mm-hmm.
but why it's happening.
The why is everything.
So it's like being a detective,
Yeah.
but also an economist. You're piecing together the clues, but also analyzing those underlying forces that drive those market movements.
It's a multidisciplinary approach.
So once we've spotted a potential opportunity,
Okay.
whether it's through statistical arbitrage or some other method,
Right?
we need to back test our strategies.
Absolutely. Before we risk any real money,
Rigorously back test them.
rigorously.
And we talked about the importance of testing on both in-sample and out-of-sample data to avoid that data snooping bias.
Right. You don't want to fool yourself
Right.
into thinking you have a winning strategy when you don't.
And Aldridge actually gets into some very specific techniques for back testing.
Oh, does she?
HFT strategies,
Okay.
like walk-forward analysis.
Right. Where you test your strategy
Yeah.
on progressively newer chunks of data.
Right. So it's like giving your algorithms a series of pop quizzes,
I like that analogy.
make sure they're still sharp,
Yeah.
can adapt to new information.
Keep them on their toes.
And another technique. Yeah.
Is Monte Carlo simulation?
Yes. Where you generate thousands of hypothetical scenarios
Yeah.
based on historical data.
So you're not just assuming that the...
So we were talking about how those algorithms are tested, right?
Yeah.
And how you can't just assume the market will behave predictably.
Right. You got to throw everything at them. Booms, busts, flash
Oh.
crashes.
Exactly. It's about making sure those strategies can weather any storm.
And then meticulously analyzing the backtest results.
Oh, absolutely. Got to scrutinize every detail.
That's how we refine the parameters, identify those hidden weaknesses,
It's all about fine-tuning.
and get a more realistic view of the risks and the rewards.
Just preparing for the unexpected.
But even with all that prep work,
Right.
actually implementing these strategies in a live trading environment, that's a whole other level.
You're right. It's where the rubber meets the road.
So what are some of the key things to think about when you're actually building
Mm.
and deploying an HFT system?
Well, first and foremost, your technology needs to be top-notch. Yeah, it's got to be cutting edge.
We're talking powerful servers,
Okay.
lightning-fast connections,
Of course.
software that can handle those massive data flows
Right.
and make those split-second decisions.
So it's not just about having a brilliant algorithm.
No.
You need the hardware and software muscle to back it up.
Absolutely. It's like having a world-class race car driver.
Yeah.
But you also need a top-of-the-line car.
And a killer pit crew.
Exactly. You need the whole package.
And we can't forget about regulations,
Ah, yes, the regulatory landscape.
which can be a minefield depending on where you're trading.
It varies so much from country to country,
Different rules, different requirements.
and the penalties for noncompliance can be steep.
So it's not just a technological challenge.
No.
It's a legal and compliance one as well.
Absolutely. Yeah, stay on the right side of the law.
So once our system is live and running,
Mm-hmm.
we need to keep a close eye on things.
Oh, absolutely. Constant monitoring is key.
Tweaking,
It's
adjusting.
an ongoing process.
As needed, this is where those risk management tools
LAR, CVR, all those good things,
really come into play.
they're essential.
Because even a tiny error in your algorithm
Right.
can snowball into a major loss.
Especially at those speeds.
Right. It's like those high wire acts at the circus.
Oh, yeah.
You need incredible balance,
And
focus.
it's constant adjustments.
Yeah, just to stay on the wire.
And sometimes you even have to know when to cut the rope entirely,
Whoa.
shut the whole system down.
If things get too crazy.
If those parameters go haywire, you got to protect yourself.
So it's about having those safety nets,
Mhm.
knowing when to take your foot off the gas.
Even if it means missing out on a potential opportunity.
Better safe than sorry.
Exactly. Preservation of capital is paramount.
Now, Aldridge talks about this specific part of HFT implementation
Yeah.
that I think a lot of people overlook,
Go with that.
the FX protocol,
Ah, yes. The FX protocol.
the Financial Information Exchange Protocol.
Right. It sounds very technical.
It is, but it's super important.
Okay. Remind me why.
So think of it as like the universal language of
Wow.
electronic trading.
The lingua franca.
Yeah, it's the standard way to transmit all that real-time financial information.
Orders, executions, quotes, all of that.
All of it. Between brokers, exchanges, traders.
It's how they all communicate.
Yeah, and in HFT, where speed and reliability are everything,
Right.
having that standardized protocol like FIX
Yeah.
is crucial.
It's like having a perfectly synchronized orchestra
Yeah.
where every instrument is playing in harmony.
So we've got the technology,
Yep.
the regulations, the communication protocols all sorted out.
Right.
But even with the most sophisticated HFT system in the world,
Mm-hmm.
risk is always there.
It's the one
That
constant.
lurking in the shadows.
Always got to be on your toes.
So how do we manage that risk
Right.
in a live trading environment
Ah, the art of risk management.
where the unexpected is the norm?
It's a delicate balance.
And Aldridge really emphasizes
Okay.
that it's not just about reacting to events as they unfold.
It's about anticipating.
It's about being proactive,
Yeah, putting those safeguards in place.
minimizing those potential losses.
Thinking ahead, planning for those worst-case scenarios.
So it's like building a fortress
Mhm.
around your trading operation
With multiple layers of defense.
to protect you from those market storms.
Absolutely, you got to be prepared for anything.
And Aldridge outlines these 4 broad categories of risk
Yeah.
that HFT operations need to manage.
What are they?
Market risk, credit risk, operational risk,
Okay,
and liquidity risk.
those are the big ones.
Each one has its own unique challenges in the HFT environment.
They do. Each one requires a different approach.
So let's break those down one by one,
All right, let's do it.
starting with market risk.
Yeah.
What makes managing market risk so unique in the HFT environment?
Well, market risk is always a concern for traders.
Of course.
But in HFT, it's amplified
Yeah.
by the speed and the leverage involved,
Right, because even a tiny price movement can translate into a big loss.
especially when you're leveraged up.
It's like riding a motorcycle
Yeah.
at 100 miles an hour.
Whoa!
Even a slight wobble
Yeah,
could send you flying off the road.
that's a good way to put it.
So you need those lightning fast reflexes
Absolutely.
to stay in control.
You got to be able to react instantly.
Okay, so how do HFT operations do that?
Well, they have those sophisticated risk management systems
Okay.
that monitor the markets in real time,
Okay.
adjust positions,
Is needed.
and prevent those runaway losses.
So it's like having a team of expert stunt drivers
Oh, yeah.
behind the wheel
Constantly making those split-second decisions.
to keep the car on the track.
Exactly. That's a great analogy.
And on top of that, they also use those quantitative risk measures
Or CVR.
to get that big picture view.
Yep, got to have that holistic perspective.
So they can make those tough risk-reward trade-offs.
Exactly. It's all about finding the right balance.
So market risk is about being agile, adaptable, having those systems in place to protect yourself.
And always being one step ahead.
Now let's move on to credit risk.
All right. The risk of someone not paying up.
Right. Counterparty defaults.
A constant worry.
Especially when trades are happening so fast.
You don't have a lot of time to vet everyone.
So how do HFT operations manage that?
Well, they typically mitigate credit risk by being very selective
Okay.
about who they trade with.
So they stick to those reputable counterparties.
Yes, the ones with a proven track record.
And they also use clearinghouses
Yes, the clearinghouses.
to guarantee those trades.
They act as intermediaries.
Right, making sure both sides fulfill their obligations.
It's like having a trusted escrow agent.
Yeah, like in a real estate transaction. So
Exactly.
making sure the money and the property actually change hands.
They add a layer of security,
So it minimizes those potential losses from defaults.
which is always a concern.
But especially in the high-speed world of HFT.
Where things move so quickly,
Okay, so credit risk is about choosing your partners wisely.
having those safeguards in place.
Absolutely.
Now, what about operational risk?
Ah, yes. Operational risk. This is a big one.
This seems like a particularly challenging area for HFT.
It is, because it's all about those errors, those glitches.
Yeah, human mistakes, technical failures.
Anything that can disrupt those systems and processes.
And in HFT, a tiny error
Right.
can quickly turn into a major headache.
It can cascade, snowball into a major issue.
It's like a tiny crack in the hull of a spaceship.
Oh, yeah.
It might seem insignificant,
At first.
but it can lead to a catastrophic failure.
A very apt analogy.
And that's why HFT operations need to have
Yes.
super
Because-
robust technology,
Absolutely. Got to have those redundant systems.
rigorous testing protocol.
And constant monitoring.
So it's not just about being fast.
Right.
It's about being resilient,
Yeah.
being able to withstand those shocks.
Building a bridge
Okay,
that can withstand those earthquakes and hurricanes.
you need that solid foundation.
So operational risk is about having those systems and processes to prevent those technical and human errors.
From spiraling out of control.
Right. Okay, now let's tackle the last piece of the puzzle.
Okay.
Liquidity risk.
Yes, the risk of getting stuck.
How do HFT operations manage the risk of not being able to buy or sell an asset quickly?
At a fair price.
Right, because that's the key.
It is. You don't want to get caught holding the bag.
So this is something that all traders need to be aware of.
Of course.
But in HFT, it's especially challenging.
It is because of the speed and the volume.
If you need to exit a position quickly,
Right.
you might not find a buyer or a seller.
At the price you want.
Right. It's like trying to hail a cab
Okay.
in a downpour.
During rush hour.
Yeah, you might eventually find one.
But you're going to pay a premium.
So how do they avoid that?
Well, they keep a close eye on market liquidity.
Okay.
They adjust their strategies accordingly,
So they're constantly monitoring.
always adapting.
And they have those backup plans.
Just in case.
So it's about being nimble,
Yeah.
adaptable.
Reading the market.
Yeah, and
Yeah.
constantly tweaking your approach.
Exactly. You got to stay ahead of the curve.
And it also highlights why it's so important to trade in liquid markets.
Absolutely. You need those buyers and sellers
Plenty of action.
to make sure you can get in and out of positions easily.
All right, so we've covered those 4 big categories of risk.
Market risk, credit risk, operational risk, and liquidity risk.
The 4 horsemen of HFT risk.
Got to keep them at bay.
But let's zoom out for a moment
Okay.
and talk about the human element.
Yes, the human factor.
Because it's not all just algorithms and code, right?
No, it's not.
What kind of skills,
Yeah.
expertise are needed to really succeed in HFT?
Well, it takes a special kind of person.
Yeah.
Someone who's comfortable with complexity,
Okay.
who can think both technically and financially.
So we're talking about individuals who are comfortable with those algorithm, data analysis,
Yep.
but also have a deep understanding of how markets work
Right? They need that market intuition.
and how to develop those winning strategies.
It's a rare combination of skills.
So analytical,
Absolutely.
problem solvers,
And adaptable.
Mhm.
Because the HFT
they're
landscape
constantly evolving.
is always
You
changing.
got to be able to keep up.
So it sounds like a very demanding field.
It is, but also very rewarding.
Intellectually stimulating.
Absolutely, you're always learning.
Now, let's talk about the future of HFT.
Okay, gazing into the crystal ball.
Where do you see this field heading in the next few years?
Well, I think one of the most exciting trends is the rise of AI and machine learning.
AI.
Yeah, those algorithms that can learn from data,
Right.
adapt to changing conditions.
So it's like those self-driving cars,
Okay.
but for financial markets.
Exactly. Algorithms that can navigate the markets on their own.
And another trend we're seeing is a growing focus on regulation.
Ah, yes, regulation.
Because as HFT has gotten bigger,
More influential.
the regulators are paying more attention. They are. They're trying to keep up.
More scrutiny, new rules, regulations.
It's a constantly evolving landscape.
So it's not just about speed and profits anymore. It's
Yeah.
about operating responsibly.
Yeah, being a good citizen of the market.
So this shift towards a more responsible approach is likely to continue.
I think so. The only way forward.
Now, before we wrap up this part of our deep dive,
Okay.
I have one final question.
All right, shoot.
Given all this automation, all these sophisticated algorithms, what do you think the future holds for those human traders?
That's the big question, isn't it?
Are their days numbered?
Well, it's certainly a topic of much debate,
Yeah.
but I believe there will always be a role for human judgment,
Okay.
intuition,
Yeah.
and creativity in the markets.
Because we bring a unique perspective.
We do. We can see things that algorithms can't,
We can understand those nuances,
those irrationalities.
those sometimes emotional factors that drive market behavior.
Exactly. We bring that human element.
So it's not about humans versus machines.
No.
It's about finding that synergy,
Yeah, that collaboration
harnessing the strengths of both.
to create a more efficient, more dynamic market.
So the future of trading is this kind of collaborative dance between humans and machines.
Exactly. A beautiful partnership
Each leveraging their unique capabilities.
to navigate this complex world.
That's a really encouraging perspective.
It is. I think it's a bright future.
This has been a fantastic conversation
It has.
about the world of HFT.
Fascinating stuff.
Really insightful, and I think our listeners will agree
I hope so.
that we've kind of demystified
Shed some light on.
this often misunderstood corner of finance.
Yeah, it's not as scary as it seems.
Now, before we sign off,
Okay.
I want to leave our listeners with one final thought.
Right.
Even though HFT is often portrayed as this purely quantitative
About it.
world, it's important to remember that there are brilliant minds
Be in mind.
behind those algorithms.
Absolutely.
Constantly pushing the boundaries,
Innovative.
finding new ways to navigate those markets.
It's a testament to human ingenuity.
And on that note, I want to thank you for joining us
Thank you for having me.
on this deep dive into high-frequency trading.
It's been a pleasure.
And to our listeners, thanks for tuning in.
We appreciate you.
We'll be back soon with the final part
Okay.
of our deep dive,
Looking forward to it.
where we'll unpack the nuts and bolts
Yeah, right.
of executing those HFT strategies
The practical side.
and analyzing those post-trade results.
Got to make sure it's all working.
Until then, keep diving deep. Okay, so we've talked about the strategies, the risks, all that, but I want to know how it all comes together in practice. How do those HFT strategies actually get executed, in the blink of an eye?
That's where those execution algorithms come in.
Ah, the execution algorithm.
That's what Aldridge really gets into in this book.
Okay,
These are those specialized pieces of software
right.
that are designed to make sure our trades are happening quickly, efficiently, and with minimal cost.
So it's like having a team of elite ninjas
Okay.
working behind the scenes to, slice and dice those orders
Yeah, I like that analogy.
to get the best possible result.
Yeah, they're like our silent warriors out there in the market.
And these algorithms, they're not static, are they?
No, they're constantly evolving, getting more and more sophisticated.
So what are some of the factors they take into account?
Well, they consider market liquidity order, book depth volatility, even our own risk appetite.
So they're making these really calculated decisions.
They are. It's not just about speed.
Right.
It's about intelligence.
Okay. And one of the biggest challenges in execution is minimizing that market impact.
Ah, yes. Market impact, the bane of every trader's existence.
Because the more you trade,
Right.
the more you can actually move the market.
Exactly. And that can work against you.
So how do these algorithms try to minimize that impact?
Well, one technique is order slicing.
Order slicing. Okay, break that down for me.
So let's say you want to buy 10,000 shares of a company.
Okay.
If you place one massive order,
Yeah.
it's like setting off a flare gun.
Everyone sees it.
Everyone sees it, it can spook the market.
Drive the price up.
Exactly.
And that hurts your execution.
It does. You end up paying more than you wanted to.
So it's like trying to buy up all the beachfront property
Yeah.
in a small town.
All right.
If if you come in waving a suitcase full of cash,
Yeah, you're going to attract attention.
you're going to drive those prices up.
Exactly.
People are going to get suspicious.
They're going to wonder what you're up to.
But with order slicing,
Yeah.
your algorithm takes that big order,
Breaks it down.
breaks it into smaller pieces,
Little bite-sized chunks.
and then it just discreetly feeds those smaller orders into the market over time.
Like a stealthy ninja.
So it's more like quietly buying up those beachfront properties
One by one.
under the radar.
Until you've built your empire.
So order slicing, it's like the art of stealth trading.
It is. It's all about minimizing your footprint.
Okay, so beyond order slicing, what other tricks do these algorithms have up their sleeves?
Well, there are hidden orders.
Hidden orders, what are those?
So a hidden order is like a secret agent.
Okay.
It's not visible to the rest of the market.
So it's like lurking in the shadows.
It's waiting for the right moment to strike.
Okay.
And then there are iceberg orders.
Iceberg orders.
So these are large orders,
Mhm.
but only a small portion of them is
Yeah.
visible.
So it's like an actual iceberg.
Exactly. The bulk of it is hidden beneath the surface.
So you're only showing the tip,
Just enough to keep things moving,
but hiding the rest.
to avoid spooking the market.
So it's like a high-stakes poker game,
It is. It's all about deception and strategy.
trying to outsmart your opponents.
You got to be one step ahead.
Okay, so we've got the orders executed, hopefully with minimal market impact,
Right.
maximum efficiency.
That's the goal.
But how do we know if it's actually working?
That's where post-trade analysis comes in.
Post-trade analysis.
It's all about looking back
Okay.
and seeing how we did,
Dissecting those trades.
identifying areas for improvement.
So it's like those athletes who study game film.
Exactly. Always looking for an edge.
And one of the key things we focus on in post-trade analysis
Yeah.
is understanding those trading costs.
Right, because costs can eat into your profits.
So what kind of costs are we talking about here?
Well, first off, there are broker commissions.
Those are the fees we pay to our brokers.
Exactly, for executing our trades.
Then we have exchange fees.
Charged by the exchanges themselves
Okay.
for using their platforms.
And market impact costs.
Right. We talked about those earlier.
Remember, when we buy or sell large quantities,
Mm-hmm.
it can actually move the price.
And that can impact our profitability.
So it's like trying to buy a rare comic book
Yeah.
at a convention.
All right.
If you're too eager,
Too enthusiastic.
yeah, you might end up paying more than you wanted.
You might drive the price up.
So minimizing market impact isn't just about execution.
It's also about cost control.
Now, what about opportunity costs?
Ah, yes. The phantom profits.
Those are the gains we miss out on,
Because we didn't make the right trade.
or because our execution wasn't fast enough.
Exactly. Those missed opportunities.
It's like that feeling when you sell a stock
Yeah.
and then it skyrockets the next day.
You're left wondering, what if?
And finally, we have slippage.
Slippage, the gap between the price you expect
Yeah.
and the price you actually get.
It's like those hidden fees.
Yeah, like ordering a pizza online.
And finding out there's a delivery charge you didn't know about.
It throws off your whole budget.
So slippage can be a real profit killer in HFT.
It can, especially in those volatile markets.
Okay, so we've got a lot of costs to keep track of.
We do. It's all part of the game.
But how do we actually measure the effectiveness of our execution?
That's a great question.
How do we know if we're actually getting those best possible prices?
Well, it's not always straightforward.
And those traditional benchmarks,
Like TWAP.
they don't always work well for HFT.
They don't because they're not sensitive enough.
So we need a more precise measure,
Yeah.
something that reflects the speed
And the granularity.
of HFT execution.
Right.
And what does Aldridge suggest?
Well, she introduces this concept of a relative performance measure.
Okay, a relative performance measure.
No, instead of comparing our prices to an average,
Mm-hmm.
it compares them to the prevailing market prices
Okay.
throughout the entire trading window.
So it's like a real-time scoreboard.
Exactly. It's constantly tracking our performance,
So we can see how well we're doing.
second by second.
Wow, this has been an incredible journey into the world of HFT.
It has been fascinating.
I feel like we've really peeled back the curtain
Demystified the process.
and gotten a true insider's view of how it all works. It's a complex world. But I think our listeners will agree that we've learned a lot
I hope so.
and come away with a much better understanding of this sometimes controversial but always fascinating corner of finance.
It's definitely a force to be reckoned with.
Now, before we sign off,
Right.
I want to leave our listeners with one final thought.
All right.
Even though HFT is often portrayed as this, cold and calculating world,
All about the machines.
it's important to remember that there are brilliant minds
Human minds.
behind those algorithms.
Absolutely.
It's those minds that are pushing the boundaries, refining those strategies,
It's a testament to human ingenuity and creativity.
and ultimately shaping the future of finance.
I completely agree.
So on that note,
Mhm.
I want to thank you for joining us on this deep dive.
Thank you for having me. It's been a pleasure.
And to our listeners, thanks for tuning in.
We appreciate you.
We hope you've enjoyed this exploration of high-frequency trading. Remember, knowledge is power. So keep exploring, keep asking questions, and most importantly, keep diving deep.